Hey everyone, if you've watched my previous video, I went through a sample of Peter Professor and Paula Professor doing a financial plan for them, setting the initial stages up. And in that analysis, there was a bunch that we covered, but one of the big ones was the tax strategy and doing Roth conversions. And when it comes to tax planning, there's really two realms we have to deal with. First is the long term. What is the long-term tax strategy to lower your lifetime tax bill over your whole lifetime? And then the other part is just in this year getting it right, getting those tax moves executed and accurately. What I do is I would take that information, plug it into a totally different software, and we start looking at under a microscope, what are we doing this year? I took a sample, completely dummy account again for Peter Professor and Paula Professor, but it was a sample tax return. And I'll walk you through what we used in the long-term planning, figuring out, hey, we want to use the 22% tax bracket, but we also were modeling out the tax deductions that they would get if they do the 401k contributions and HSA contributions. Now, there's other tax moves we could do, but for that analysis, I'm just using the HSA and 401k and seeing what that would do to their tax bill for this year, 2026. So here we are. I took 2024 numbers. You'll see here they have their wages of $124,000. They have their interest coming in and dividends from their investments. And these are the IRA distributions from the inherited IRA that they have. Here we have their short and long-term capital gains of $22,000 in total. And the side gig work that Peter has brings in $52,000 a year. So all in all, I would take a review of everything, go over this with them, and then I'd bring up, hey, this is your state property tax, but they're in Texas, so they don't have to worry about that. And I would look at some of the other things that come to mind, like the mortgage interest and the charity. Now, let me focus on the charity for a moment. Here, they're gifting $10,000 a year. I'm going to keep that the same and the other scenarios that I'll run, but I want you to keep this $10,000 number in mind. Now, when I go down to their total federal tax, you'll see here that they owe $30,864 for that year. That was what they ended up owing total tax-wise. Now, I'm going to go back and make some adjustments up here to their wages. What I did was a 401k contributions of 10% each. That totaled $24,800 and divide that out by 2. But essentially that 124 is now getting reduced by the $24,800 401k contributions that they're now making based on the plan. Secondly, when we come down here, you'll see that their charity donation came down. It didn't really. What happened was this is the deduction that they can make. Now that would actually be usable. Even though they're gifting away $10,000, the amount that's deductible because of the way their AGI works, adjusted gross income, they're now only eligible for $8,889. So this would be a conversation had as to how much we want to gift this year. Now let me scoot on down here. What you'll see is we have a total tax of $27,511, and they went from here owing $864 because they had $30,000 withheld at work. So they had total tax of $30,864. They've been withholding $30,000. They're left owing the IRS at tax time $864. Not so nice. Without making any more money and just doing the couple changes that are recommended here for them, you could see they went from $30,000 now to $27,511 in total tax owed. They still withheld $30,000. Let's say for this example, they just didn't want to change anything at work. And they ended up getting a refund, $2,489. Look at that swing. Without earning any more money, simple tax changes can make a big difference. And that's a nice little tax refund they can get as opposed to owing at that time. And if they wanted to get to zero, we would just reduce this tax total withholding down by this number so that we can get to zero or as close to zero by the end of the year. Now, the second part to this was we were looking at doing Roth conversions using up to 22% tax bracket. So what that looks like here, and let's say I'm meeting with the client in this year, 2026, and we're doing the 401k contributions. We're also doing the HSA. I forgot. HSA, $87.50. That's the total amount they can make. Now we do the same thing here, but now we're going to add in a Roth conversion using the 22% tax bracket. So you'll see that here, everything is copied over from this last scenario. So we're getting the tax deductions from the 401k and the HSA moves that we made. But the big change that's going to happen here is when we go down. So I was able to look at their tax bracket and realize that, okay, based on everything that we did, we have $28,000 of room in that 22% tax bracket to convert this year. And we would do a little bit each year based on our strategy, but for this year, we know 28,000 would do it. So we take that now, and that's going to add to our income, but not as bad. Here we go, as we may have thought. So here we are. Now total tax owed is $33,708, and they end up owing $37,008. That's because we kept the tax withholding the same. What we would recommend doing here is now increasing the tax withholding at work by this number, the $37,008, so that when they get to tax time, they're as near to zero as possible. Now, we would do this every year and figure out how much margin they have in the tax bracket to use up and convert that amount and adjust the withholding at work until we reach the end of our strategy there. Hope this helps. And I know Roth conversions and tax planning can be complex. So that's why it's a big part of what I do. If you're interested in this type of work, please reach out, schedule a call, email, and I would look forward to working with you. Thank you. Have a good one.